This is Richard Dennis, one of the most famous traders who made millions in the 70s and 80s. And here's the part that sounds fake. At just 22 years old, he borrowed $1,600 and turned it into $350 million. Yes, $350 million. And what's even crazier? He did it in **9 years**. That's not normal. And it didn't come from some complicated, Wall Street secret. Dennis used a simple, unorthodox strategy that most traders mocked him for. At the time, another elite trader, William Eckhart, insisted that trading can't be taught, that it's pure natural talent. Dennis believed the opposite, that anyone could learn to trade if they were trained the right way. So he did something that became legendary. He ran an experiment. He recruited and trained *21 men and 2 women from totally different backgrounds, clerks, musicians, chess players, regular people with zero trading experience. This group became known as the **Turtle Traders**. 5 years later, the results were undeniable. The Turtles generated $175 million in total profit. Dennis's students proved something most people don't want to hear. Discipline beats talent, every time. In fact, Dennis expected to lose on most trades. That was the plan. But when a trade went right, he would hold it for weeks, sometimes months. And that's what made the entire strategy explode in profitability. Today, several former turtle traders became successful hedge fund managers, like Jerry Parker, and many reached millionaire status long ago. So if you're like me, you're thinking, how did he do it? I went looking for the real answer, digging through books, interviews, and the internet to find the exact framework behind those massive gains. And what I found was genuinely eye-opening. Richard Dennis wasn't lucky. He was a machine. And I'm going to break it down for you. So if this helps, drop a quick thank you in the comments, because we're getting straight into it. Before we jump into the exact strategy, you need to understand the core principles Dennis built everything on. Risk a fixed percentage per trade, cut losses fast, let profits run, trade trends, not predictions. Dennis drilled one rule into his students. Risk no more than 2% of your account on any single trade. That exact number can vary depending on strategy, time frame, and asset, but for Dennis, strict risk control was the foundation. Because his entire edge came down to one ruthless concept, cut losses immediately and let winners run. That's the line separating professionals from everyone else. Let me show you what that looks like on a chart. Here we can spot a major resistance zone. Price has hit it multiple times and dropped each time. Over and over, it fails, until one moment when the market finally breaks the structure. And then what happens? The trend launches upward. This is what Dennis wanted his students to understand with absolute clarity. You don't need perfect entries to make money. You can enter in many different places, as long as your risk management is correct. Or as he believed, trading should be based more on numbers and math than emotion and psychology. Here's a simple example using the same structure. Imagine a beginner trader. Instead of marking the true resistance area, he draws it incorrectly, based on just 2 highs, and places his resistance line here. He waits for a break and enters on a breakout. He loses. Then he loses again. And again. Until eventually, a breakout candle appears that starts a real uptrend. Now look at Dennis's logic. If you keep losses small and controlled, but when you finally catch the real trend you let the trade run, the math flips in your favor. You might lose this amount, then another small amount, those are your total losses. But when the one trade runs, your gain is massively larger than everything you lost. Net result, gains minus losses equals profit. That's the philosophy. And no, Dennis wasn't entering randomly all the time. He used a precise system and specific variables, which we'll cover next. But the most important idea is this: you can lose small many times, and still win big overall by winning huge a few times. This shocks beginners, but it's the truth. You don't need a high win rate to be profitable. You can lose 9 trades with a 1% stop loss, then on the 10th trade make 25%, and you still come out far ahead. Now imagine doing that consistently, not over 10 trades, but over 1,000, 10,000, or a million trades. If you look at any chart, the market repeats the same rhythm: trend, consolidation, breakout, continuation, consolidation again, over and over. So logically, if your system cuts losses quickly and occasionally catches an entire trend, you'll make far more on the few winners than you lose on the many losers. So what's the real problem? The problem is not the strategy. It's people. Most humans have terrible psychological tolerance for repeated small losses. Without discipline, practice, and understanding, they panic, hesitate, revenge trade, or abandon the system, right before the big winner arrives. Dennis said something billionaire traders still repeat today. ***, your emotions are the reason you lose money. Even if a professional tells you exactly what to do, without experience and repetition, you'll sabotage yourself. Now let's go step by step through how Richard Dennis specifically used price action to turn $1,600 into $350 million. As we saw earlier, Dennis relied heavily on direct market movement, price action. That meant paying close attention to previous structural highs and lows for entries. So we go to the indicator section and choose ***, highest high, lowest low ***, an indicator that highlights key structural high and low zones used to build the strategy. Then we go into settings and set the period to ***, 20 because Dennis studied market structure in 20-day or 20-period cycles. We remove the moving average and keep the structure lines. Now the chart constantly shows the evolving highs and lows, how price interacts with an upper zone, ranges, breaks down, forms new lows, breaks again, and repeats. Dennis also used the *ATR, average true range, ***, a simple volatility indicator. We add ATR, then change the length from 14 to ***, 20. In smoothing, we select SMA. Then we add a moving average inside the ATR settings and also set it to ***, 20 so it smooths the volatility data. Now we have ATR and its 20-period average, both set to 20, exactly how Dennis preferred. Next, Dennis would add one more filter, a simple moving average to define the bigger trend. For the broader trend view, we set it to ***, 200. Now we have a clear framework. If price is above the 200 moving average, we focus on bullish breakouts. If it's below, we focus on bearish ones. Dennis's rule: first, identify a structural breakout in the direction of the trend. Here's the previous high zone, and here's the candle that breaks it. When that breakout candle closes, Dennis placed the stop loss using ATR. You look at the ATR average value, multiply it by 2, and subtract that from the breakout candle close. That distance becomes your stop loss. In this case, price hits the stop loss. Trade lost. But that's part of the plan. Later, price breaks the highs again. We repeat the process, check ATR, multiply by 2, subtract from the close, place stop. Another loss. Then price breaks again, and this time, the breakout is real. The stop doesn't get hit. Price runs. Now where do we take profit? Dennis's answer: you let the trade run until the market breaks the lows that signal the move is ending. Once those lows are broken, you exit. So what happens overall? We lose small here, total losses add up to this. But on the one trade that runs, we make this much larger move. Even with multiple losses, the net outcome is strongly positive, because the winners are allowed to grow far bigger than the losers. This is the exact, unorthodox strategy other traders criticized Dennis for, yet it's the same method that made him and his students millionaires. Dennis believed you win in markets not by knowing everything, but by forcing risk management to win the war for you. Even if your strategy is simple, disciplined risk control makes it powerful. He also mentioned that this 20-based system worked well for short and medium-term time frames, like the 1-hour chart. But for higher time frames like daily or weekly, he adjusted the breakout window, using ***55* instead of 20, so breakouts represented larger, more meaningful structures. If we switch the upper band from 20 to 55, you'll see fewer breakouts qualify, but the entries become safer and stronger for bigger time frames. Richard Dennis is one of the greatest trading minds of the last 100 years, someone who proved that the market doesn't reward intelligence as much as it rewards discipline. Thank you all for your support, and I'll see you next time.